So the first understanding you want to really have is that you need to be a good candidate on paper. So really, what does that mean? You have a great credit score, you have liquidity, i.e. cash available to purchase, you have a stable income, you have a reasonable net worth relative to the property you're buying. So if you have all those things, number two, generally a bank is going to be looking for what down payment do you have available for the property in question while still having a reasonable amount of reserves. The third thing they're going to be looking at, which is really a large key determinant, is the debt service coverage ratio, which essentially means that they want to see the property have 20% more income than the amount that it takes to cover all the expenses for the property plus the debt service payments and still have a buffer of 25% above that. So that's what the bank is looking for, just to make sure that there's basically a safety net, that you're not going to get yourself into trouble if you can't cover that debt service. So oftentimes lenders, if the property is a little bit skinny on debt service, which it commonly is in today's world, they might look at a global debt service coverage, meaning if you have properties where you have significant equity in them, they will take those properties into account if they have a much higher cash flow, and then just looking at the property in question. So that can be a good way to add more units into your portfolio and not have to have each one stringently qualify. The fourth thing that banks are looking for is that personal guarantee. And I tell you what, not just for the borrower, but their spouse as well if they're married. And that's because the law states that any assets that when you're married, if both of you own them, then a bank can't seize them without having the guarantee from the other person as well. So oftentimes they're looking for the personal guarantees, including both spouses. And the fifth requirement is just some post-closing liquidity, meaning you'll have cash on hand after your down payment and your closing costs when you purchase the property to make sure that you're stable. And generally, they're looking to have about 5 or 10%.